that heading, that title's a bit of a mouthful, and hopefully I'm going to achieve all of that today and get the point across. The points that we're going to be covering today are not trivial. They're pretty deep, and trading is a deep, meaningful thing. So if we treat this as a superficial, just a surface level thing that we do and laugh, then we're going to get superficial results. That's what's going to happen, and we're going to get surface level type results. We have to go deep to be able to get deep results. So I'm going to go a little bit deep today. I don't apologize for that, and hopefully I'll make some of the points. So why are you here? Why have you come along today? Hopefully it's to improve your trading. Might be many years ago that I suggested to Charles Brown, when he was president of the ATAA, that a rename of the ATAA should be Australian Technical Analysts Association to Australian Trading Association. And I think it's evolved to that now from where it was 30 plus years ago. But what's got you here to improve your trading? Is that to improve your results, to improve your analysis process, or to improve your skills, or a combination of all of those? And it's important that we get those in order, in the right order. And right there as they are, they're in the wrong order. You can't just go straight to improving results. There's some stepping stones along the way. There are these little things called skills and habits that you have to improve first. So if you come along to stop losing from making mistakes, everybody makes mistakes. And this game is, as much as people talk about it as being risk management, to me, it's more mistake management. And if you can reduce your mistakes, the size of them and the number of them, then that's where we're going to get to. But where do these mistakes occur, and what are they, and how do you define them? That's what we're going to get into today. And or if you come along to start trading with excellence, and I put them red and green for obvious reasons. The one is a negative motivation, the other one's a positive motivation. And I'm going to put to you today that you need to start with the positive motivation. That's the end goal. To get to trading excellence, or the words being thrown around a lot these days, trading mastery, and it's borrowed from martial arts and mastery, and you should go and look it up and read about it, because there are so many parallels of other walks of life to trading. However, the path to get to there is very different from other parts of our lives. So we're going to aim at trying to get to trading excellence, and that was obviously in the title. And I'm going to show you a path, a tangible path that every single one of you here today can do. So is this for you? Or is this you? Just to define the people that I think, and I'm making some assumptions here, but hopefully I'll get all of you in these assumptions, right? You've placed many trades, but you're still getting inconsistent results. And I know that's a loose term, and universal inconsistent results, because that could mean different things to different people. But it doesn't have to be that. There is a very specific way of knowing that you've achieved consistency. Okay, you feel uncertain with your buy-sell decisions. You keep tweaking your analysis after losses, or when you're in drawdown. You don't touch them when your portfolio is going gangbusters and you're making lots of money. Do you system hop? Do you indicator hop? Do you parameter hop? Do you find yourself changing look-back periods all the time and just changing it, from one Fibonacci number to another, or just even in steps of one, thinking that that's going to solve the problem? You kind of know that it's not going to solve the problem, but you try it anyway. Why? Because you're out of ideas, and you're trying to solve this problem by tweaking with the things that are tangible and that Do you often pause and stop trading, due to discomfort, due to these awful feelings that you get from things go wrong by your definition in the market? I know you're probably profitable. A lot of you will be profitable. The fact that you've either joined the ATAA or in some other association around the world that's affiliated to IFTA, and you're profitable to some degree, but you still searching for better profits. You want to get better. You're seeking that perfection, or you still have some technical analysis technique itch to scratch, because there are so many out there. There's so many variations of them, and there are new ones coming out, and there's so many patterns, within sub-patterns, within patterns, and you never know it all. But so you're kind of wanting to, as long as you're not achieving what you think you should achieve, your potential, if you like, under the pressure of the market, you think that I can go and find a little corner, a little secret somewhere in the realms of technical analysis that's going to solve my problem. Well, technical analysis, part thereof, somewhere in there is a very, very important part to play. And hopefully that gets made obviously clear to you today. Right. So I'm going to make a big promise that all of these are going to be Gonski. None of these will be issues. You'll be able to solve all of these, not at the end of the presentation, but you'll have a path, a tangible set of actions that you can embark on and start and step into a process that you can overcome all of this. Right, big promise. Let's see if I can deliver. Right, so the hard truth about trading results is that, and just painting the picture of how tough this gig is that 85 to 93% of investors underperform the market. How do I know that? If you're unfamiliar with the SPIVA scorecard or the SPIVA persistent report, look it up, persistence report, look it up, and you'll find that 85% of investors underperform the ASX 200 accumulation index. That means that equity indices, equity balance funds, equity funds and managed funds in Australia, that's not balanced funds. Balanced funds over the long term do worse than equity funds. So that's all share, if you like, all share market funds. 85% of them over 15 years and longer underperform the ASX 200 accumulation index. The 93% are the number of equity funds that underperform the S&P 500 total return index, that's including dividends, in the United States. So people who just invest are going to be in that category. So you say, well, what? I might as well just invest in the index then. So become an index investor, and that way I'm going to be 100%. I'm actually going to match the index. So you won't quite match it because there's obviously fees involved. But the big thing is that somewhere along the line the index falls by 55 to 60, and the Nasdaq fell 82% in 2001-2 bear market, the tech wreck. And at that stage, unless you have the skills I'm going to talk about today, you're not going to stick with that plan, because this is about mental skills that you need to achieve to be able to see through those periods of pain. So you might claim that index investing is for me, and I've got a whole chunk of money sitting there. Well, the longer we go into the secular bull market, which we're now 13 years into, and they typically run 12 years into, 12 and a bit years into, 12 and a half, and they typically run from 13 to 20 years somewhere. So we are closer to the end of the secular bull market than what we are to the beginning of it. So that 55, 56% on the S&P 500 and 82% of Nasdaq fall is closer than what most people think. And you need to arrange your affairs such that you'll be able to handle that. And I put to you that just buying and holding an index ETF is not the solution. And there are going to be a lot of people found out over the next 1, 2, 5, 6, 7 years when that does happen. Not if, when it does happen. And it's going to be like 2008, or it's going to be like 2001, or even the 1970s is the last really secular bear market we had before those two big falls. So that's the hard truth about trading results and investing results. So that's the investing, the traders' results we know from broker reports in the Europe and the United Kingdom. This is reports that this is regulatory reports that brokers have to submit to the regulator, that 70 to 95% of traders lose money quarter by quarter. Now, these are active traders, they're not investors, and they would be, and that means that there'd be a whole bunch of you sitting here listening today that would fit into that realm, right? Because they're not different human beings over there. And in fact, you probably, a bunch of you are listening from those geographical areas. So we know this, right? We know, and that's really saying this gig is tough. But also, many traders make a profit before they stop forever. Sorry, never make a profit before they stop forever, and that's a fact too. So and so what we also even find is that profitable traders mostly even stop. What do I mean by that? Well, if you're going to trade any kind of technique, analysis technique, whether it's mechanical or rules-based or not, or subjective, it eventually is and these profitable traders I'm talking about typically fit into the realm of leveraged short-term traders, options traders, and that it's tough to keep going with that for many decades. So I put to you that if you're going to trade, if you're going to actively invest, it shouldn't just be for 2 months, 2 years. It should be for 20 years. So whatever you're doing now, are you going to be able to do that for 20 years and plus? That's really what I mean by that statement. The truth is also that more trades doesn't equal more trading skill, because you could be doing it in the wrong manner. More analysis doesn't equal more trading skill either, Better analysis doesn't equal better trading skills. So I'm talking about trading skills here, and as opposed to results, because really you got to have the skills before you get the results. And a better system also doesn't equal better trading skills. So these are the hard truths that I'm putting to you. And by me saying that, coming to the Australian Technical Analysts Association might be challenging some of you right now. But those of you that have been around long enough might understand, might have an inkling of an understanding of what I'm talking about. So I talk about the illusion of better analysis. So trading is not analysis. It's about execution. And so there's a closed door I'm putting to you now to go looking and seeking different indicators, different parameters, different systems. And there's an open door there saying, maybe I should concentrate on how I go about executing my edge. So two keywords, the execute and edge. We're going to talk a lot about those. So changing analysis and indicators will not stop the pain. What pain am I talking about here? Well, there's physical pain and there's emotional pain. And the emotional pain is really what we're talking about here. It's awful feelings that you get that you just don't like feeling. And I'll go through a bunch of them in a moment, and they'll be scattered throughout the presentation. And here I go to a quote from Mark Douglas, which you won't find in his books. It comes from his Path to Consistency workshop. And it says analysis and trading are not the same thing. Trading is a function of proper execution. So what I'm starting to do here is divorce analysis from trading. They are two different things, and but both are absolutely necessary, but they are not the same thing. And that's what we need to understand. So when we say proper execution, what are we saying? Proper execution of what? A trading edge. And that edge, Mark Douglas always put it in inverted commas, is a statistical advantage, and it has a specific formula. It's the formula for expectancy, and you can look all this up, or even in statistics they call it expected value, or it can go by the name of mathematical expectation, or expectancy, which is a term that Van Tharp coined in his book Trade Your Way to Financial Freedom, and he explained it there in terms of R multiples. But there's a formula. Win rate times average win minus loss rate times average loss. And Ralph Vince talks a lot about this as well in his portfolio management books and his position sizing and money management books. So there's a formula, and that means that you can create an edge, a valid edge that is objective and repeatable. And this is key. And Mark Douglas used to talk about your edge has to have no wiggle room, no room to move in terms of defining when you buy and when you sell and how much money you put into each trade. Because those are the only four things you can actually, the four decisions you can make are when to buy, what to buy, how much to buy, and when to sell. There's no other firm decision that you have to make. Those are the four decisions you make, and they determine all of your results. So you have to be able to execute, make decisions about those four things, and then execute them properly at all times. So and the thing about it, that mathematical formula, is that you can calculate it, correct to a number of decimal places. So I'm going to just quickly sojourn here to talk about the Mark Douglas trading mindset. And here I've got a little picture, and this incorporates ultimately some rules and some truths and principles that ultimately that are there to train your mind to think in probabilities. Think in probabilities. What the hell does that mean? Well, hopefully I'm going to try and get that across to you in a moment. And I'm sure most of you attending today would have read Mark Douglas's book, Trading in the Zone. Who am I to be talking about Mark Douglas? Well, I met him in 2004. We invited him to a customer retreat in Hamilton Island, and we started a friendship. And for 11 years, he kind of mentored me. We spent hours on the telephone talking to America. I met him a half a dozen times in different places around the world. He did another presentation for a whole week. He joined us in Hawaii in 2011. And really all of the way that he approached trading and how he taught and coached people to really achieve consistency and achieve the mindset that successful traders get, it comes from him. And I'm really the end result of that in terms of the results I'm going to show you and how I trade in a moment. So what is that? You don't need to know what'll happen next in order to make money in the market. That's one of his 5 fundamental truths. There's a random distribution between wins and losses for any given set of variables that define an edge. An edge is nothing more than an indication of a higher probability of one thing happening over another. And the other two are anything can happen, and every moment in the market is unique. Those are the 5 fundamental truths. And if you can achieve those and understand what they are and instill them into your trading, you will learn to think in probabilities. And that means you don't think in terms of certainties. So what's thinking in terms of the certainties? Well, that's trying to find the Holy Grail. That's trying to have 100% winners. Now, you might be sitting here and saying, well, I don't try and do that. Well, you with your conscious mind don't. But unfortunately, your subconscious mind does. There's a little thing called ego, which I'll talk about in a moment, which is trying to do that all the time, not only in trading, but in other parts of our lives too. But it just seems to be that in other parts of our lives, we've managed to accept that and not expect it. But in trading, we do expect it subconsciously. Right. And so the other two of these 7 principles of consistency are: I objectively identify my edges. I act on my edges without reservation or hesitation. So what is an edge? We'll get to that in a moment. So this is all about how we think and taking technical analysis as a tool and using it to our benefit to be able to achieve certain mindset skills. So trading in the zone, Mark Douglas says the first stage is the mechanical stage, and there's 3 stages he talks about. And 4 of the points he makes there, I've already made 2 of them already, is that you've got to learn to flawlessly execute a trading system. What kind of trading system? I'll point that out to you in a moment. And you need to create a strong and unshakable belief in your consistency as a trader. Right. And so these are all, if you like, somewhere in the realm, because you can't achieve, there's no such thing as a probability of 0 or 1 in any complex system environment. Why? Because in a complex system such as the market, there are endless variables going on, all interacting with and against each other. And they can at any moment randomly, that's why there's a random distribution between wins and losses, conspire to give you a win or a positive outcome without you even trying, and vice versa, to give you a losing outcome, because we're in a complex environment. So if we can't achieve perfection, then what's next best is consistency. And you can look up the word consistency in all other realms of your life. And the more consistent you are in any process that you execute, whether it's in trading, business, sport, whatever it is, the better you will be. So that is what we have to do. We have to become consistent. So how do we become consistent? So what Mark Douglas is saying is that proper trading is primarily a function of how well you execute, not how well you analyze. And by that, I can tell you that great analysts can be poor traders and lose. You can be a fantastic analyst, but be a poor trader, poor executor of your analysis, and you will lose. You can be a great trader, a great executor of poor analysis, provided it has an edge, just a skinny edge, and you will win. You might not win as often, you might not have an equity curve that shoots through the roof, but you will win if you have an edge. Through just being a small, skinny edge and being a poor analyst, you'll win. But here's the thing, is that poor traders never win. No matter how good your analysis is, you could have the best system of the world. If you're a shit-ass executor of that analysis, you will never win. You will lose, because a set of circumstances will eventually come where your trading skill set, your trader skill set, who you are as a trader, will not be able to handle it. And you will go and do all of the things that I said earlier: system hop, indicator hop, parameter hop, and so it'll keep going. And you'll just end up in this never-ending circle of being a trading loser. So what is an edge? What is a trading edge? A trading system. And this is the definition. And Mark used to always use the word no wiggle room in his workshops, and when I spoke to him. But this is the definition out of trading in the zone: a trade entry. The variables you use to define your edge have to be absolutely precise. The system has to be designed so that it does not require you to make any subjective decisions or judgments about whether your edge is present. No debate. The market is aligned in a way that conforms with the rigid variables of your system, rigid variables of your system, parameters, if you like, indicators, if you like. Then you have a trade. If not, then you don't have a trade, period. No other extraneous or random factors can enter into the equation. No other noise, no other geopolitical events, no other commentary from writers and news and whatever on the internet or YouTube or whatever, no opinions, right? No personal opinions, no personal biases that you just feel or think that's going to happen. A bit of noise comes in from wherever, Donald Trump's got announced tariffs. Oh, I know what that's going to do. You do? What? You know what's going to happen because somebody said something? Might be in the short term, but over the long term, well, what does your absolutely precise entry signal say about that? Stop loss exit or just exit. The same conditions apply to getting out of a trade that's not working. So absolutely precise. Your methodology has to tell you exactly how much you need to risk in terms of position size and in terms of when you exit to find out if the trade is going to work. There's the references for that. Right, so no wiggle room, buy and sell. No, I'm going to use an analogy over here, which I used years ago, and I've just started using it again, and it seems to be resonating a bit, and because we're going to get a little bit into numbers here, so I have to go and find some numbers in some other area that people have general knowledge about, if you like, and understand a bit. So we're going to go to, it could be the Bellagio, it could be whatever, but I've picked on Caesar's Palace. Why does Caesar's Palace always win? Okay, now I'm not going to talk about all of the different games that can be played in a casino because they're all the same logic over here will apply, but I'm going to talk about roulette. Now, if you think of the roulette wheel as the market, and that's a European roulette wheel over there with a single zero, American will have a double zero, and the odds do change. So that's the market. And every spin, if you think of it as a trade, is a random, independent, and probabilistic outcome. And whatever the next spin or whatever that outcome is, it cannot be predicted. Nobody can predict it with certainty. Somebody might get it right once, but when they get it right once, was that a prediction or was it luck? Okay. And that, if you apply the expectancy formula, which I put to you earlier, and you can read up on all this, there's some fantastic stuff now, on the internet that when I started studying all this 25 or 30 years ago, there wasn't much on the internet. You had to go and buy books to find this stuff out, right? But that's a bit of a misnomer. That's a European roulette table over there, which with the single zero, because it has a different edge. But the edge of the house in an American roulette with a double zero is a 0.0526 mathematical expectation or expected value. And hence, the punters on the other side collectively have a minus 0.0526 edge. That's a negative edge, right? And what that really means that over a large sample is that the players are guaranteed to lose and the house is guaranteed to win in this random, independent, probabilistic environment, right? So how does why does Caesar's Palace always win? Because of consistent execution. So the skill of consistent execution activates and reveals the edge for the house. It plays out. All they got to do is keep spinning. So yes, the game's rigged, right? It's rigged in favor of the house. But people still come. Why? Because human beings are addicted to randomness. And you should question whether you are in the same boat as that, right? Because the market, just like a slot machine or a roulette table, is going to give you the odd win every now and then. And it's going to be enough to keep you addicted to pining for that win. But the longer and the more you play, the greater the probability is that not only are you going to lose, you'll lose your entire stake. That's just the way it is, right? It's just pure probabilities and mathematics. So yeah, I think you can see where I'm going with this. So why does it always win? So the one guesses, the other just executes. The one is trying to predict, the other just executes. So you don't, so the house, the casino doesn't guess, it doesn't try and anticipate, it doesn't predict, it just keeps executing. Why? Because they know their confirmed edge. They know correct to 4 decimal places. Do you know your edge, correct to 4 decimal places? Well, we'll tell you how to work that out before we get through today. And they execute the process repeatedly without hesitation, fear, uncertainty, or doubt. No FUD. Whereas the punter keeps on, all of that fear, uncertainty, doubt never goes away, right? But they're still addicted to the randomness. And the house, the croupier acting on behalf of the house, has complete trust and confidence in their consistency to execute. Because, and what do they have trust in? They have trust in their edge, and they have confidence that over a large sample it's going to play out. So if they just consistently execute, they are going to make profits. So the one guess, so there's the croupier going. So the punter is hoping his bets pay off. The croupiers just execute. Good point, with no additional analysis. They don't qualify how many bets there are on the table, the size of the bets. They just let them run. And they also just they never flinch no matter how many consecutive losses they have. They keep executing because they know that at some stage the edge is going to play out if they continue to execute. Think of this, a casino doesn't stop because it has a bad night. Now, I don't know if casinos have a bad night on the roulette table. I'm sure they do. And I'm sure they have periods, and every now and then they change the croupier to give them a break, but they do have an edge. And if they have a bad night, because they've had lots and lots of losses, they don't just suddenly give up the game and say, this is a mug's game, I'm out of here. They keep executing. Right, enough of the analogy. I'm going to come back to it in a moment, but now we're going to go back to the market and talk about the 4 risks that derail traders. These are the risks that cause us to really stop and think and to indicator hop and system hop and parameter hop. The first one is losing money from big losses, big, large losses, or from consecutive loss trades. And even some of us may not have even had a really big, large 90% loss, but we've heard about them, we've seen them, we can look at the chart, so we can visually see something that's a potential risk to us that can hurt us. Or we have consecutive loss trades, which ends up in having periods of drawdown, a dreaded word, drawdown. And another risk is being proven wrong by the market. So where we had a dead cert, you've read all this, the history about and the story about the guy, the geologist that went off to deepest, darkest Africa, found this tenement of whatever and dug down, and it was easy to find, and they were going to make trillions of dollars, and they got a dugout canoe, and they paddled back, and the whole story, it was 20 pages, 40,000 words. I'm sure you've read those. It's like a book. And this is a dead cert. It cannot go wrong. Sure, we'll take a whole bunch of money out of there and we'll put it over here because it's a dead cert. It's going to happen. And then you get proven wrong by the market. And why? Because it's a complex system, right? There are millions of variables all interacting with each other. And that one little story that has that wonderful copy written to get your emotions and heart going. Well, what about all the other variables in the market that are interacting on it at the moment? Can you comprehend those? Do you know all of those? Do you know all the things that have nothing to do with the story that can affect that environment? No. So how can you know what's going to happen? Gee, but the story was good. And then you get proven wrong by the market and you put a big stash in. That burns. It really does. It etches. It etches into your psyche. And you also want to miss new opportunities that soar in massive amounts of profit. You hear about them. You see them. Up 50, 60, 20 in a day. Suddenly they just jump out of nowhere. I want a bit of that. Fear of missing out. Then, of course, the trades that you are in that you get out of, and they soar after you've got out of them, right? And you miss this extra profit. So these are all risks that happen in the market, and we're aware of them. And the longer we're in the game, the more we become aware of them. And these risks, because they happen, every single one of them happen to us. And there's a whole bunch of reasons you can go back and find out. And that's the not so wonderful thing about analysis is that with the benefit of Harry hindsight, you can go and find a way that you could have avoided every single one of those situations historically in the past. But these risks that happen, these primary risks that happen in the market, they cause emotional pain, distrust, discomfort, disappointment, betrayal. There's a whole bunch of negative emotions that we feel that come out of that. And R2D2 struggles with these. It etches scar tissue in our brains that we then sometime in the future, when they happen again, we instantly associate with that time, and it self-sabotages our decision making in the moment, to make mistakes. And it comes from the etching of these painful things that happen when they happen to us. And unskilled traders, they feel that these are mistakes. They feel that they are dysfunction, that there's something wrong with this. And if there's something wrong with it, I have to avoid it. Okay. And this avoidance is what causes the inconsistency. So avoiding these risks feels like you're avoiding making mistakes. And then because it's a mistake and it's going to cause some kind of pain, we start building fear towards it. And the fear builds. that of these risks occurring to us again in the future. And the more they happen, the more negatively they get etched into our brain, the more we fear them, and it builds. And this threat hangs all of the interactions we have with the market, this complex system, called the market. We are thinking, our subconscious is trying to avoid these. The threatening of these potentially happening again builds this fear. And Mark Douglas uses, in his book Trading in the Zone, the analogy of a boy getting bitten by a dog the very first time he encounters a dog. And you can think of a large lost trade. It's exactly the same things that are happening. We don't have a different brain that they're operating as a human from all our other parts and encounters we have in life. And in golf, the analogy is that you see the water and not the fairway, and it threatens, right? And this picture of what you want to avoid comes into your head, and then what happens is you realize the actual thing that you fear and you're trying to avoid is what happens, because your brain just sees the picture, it feels the picture, and then it executes the picture. You got to do the opposite, right? And we have this automatic threat detection system that operates in our brain all the time. This is not new. You can look all this stuff up if you think I'm making it up or it's the first time you've heard of it, right? And our automatic threat detection systems kick in to try and avoid these threats of these 4 primary risks that happen in the market. And then we flinch, we hesitate, we lose confidence. So now the result of what's happening in our minds is this erratic behavior, distrust. We default to noise because we have no confidence or trust in our analysis. So we go and look for confirmation of a notion that we have in our head. And the wonderful thing about technical analysis is that it's so subjective. You can change anything to your heart's content, to justify the notion that you have, that you read about somewhere. And you can justify to do something or not to do something in a flash, right? And then what do? You system hop, you indicator hop, you parameter hop, you change look back periods, and you just become inconsistent. Why? Because your automatic threat detection system with respect to trading, because it happens in other parts of our lives as well, is causing you to be inconsistent. So the paradox is that avoiding the mistakes causes mistakes, because here's the thing, is that these risks are guaranteed to occur, and in droves, right? Not small samples, in droves. They happen in the market. These negative things, these risks happen in the market far more than any other environment, any other complex system that we encounter in our lives, that's what makes it so hard. And this is the problem that we have to solve. And the thing is that because they occur and they're guaranteed to occur, is that trying to avoid something that is unavoidable will have disastrous effects on your ability to trade successfully, right up in chapter 1 of Trading in the Zone. I'll just put to you now that if you think you've read Trading in the Zone, think again, you haven't. You have to study it. And I've been saying this for 25 years now. 22 years. Is that you have to reread this. We've had customers go through our training, who've read it 3-4 times and still didn't get it. And when we've unpacked it in our training, and I'm just unpacking a little bit here today, they eventually get it and they go, okay, I now get it for the 5th, 6th time that I'm reading the book. And so it's not just read it once and think you've got it, that's for sure. So you can't try and avoid something that's unavoidable. It's going to happen. So you have to go about this in a different way. And of course, this manifests in our trading as letting trades go that our analysis signals. We delay entries, we hesitate, we cut profit short before we've got an exit signal. We let lost trades fall further when we had an exit signal. We just can't bring ourselves to get out. These are all mistakes. And ultimately, they come from trying to avoid. Why do you hold on to a lost trade when you've had an exit signal? Why? Because you're trying to avoid loss, but you hang on to loss. It's another paradox. You just do these things that, in the fullness of time, when you look back at them and you go, why the hell did I do that? Well, it was because you weren't in control. And I'll put to you in a moment what is in control that manifests these mistakes. And ultimately, then you just keep on going around in this never-ending iterative circle of looking for better analysis, better system, better indicator, better parameters, whatever it might be. And I put to you now that will never, ever solve your problems. So the path that most follows is path of analysis. And they are so focused on the holy grail sitting over there at the end of the path, which, the closer you get to it, the further it's going to get away. But they don't even see the crevice that's right in front of them. And that crevice will always be there. There'll be tons of them along the path of analysis. And unless you go about this differently, stop trying to be the greatest analyst, you're going to fall down these crevices, you know, in a way that is probably going to be irrecoverable unless you rearrange, you know, you go down a different path. Why did people go down that? Because analysis is so tangible, it's so accessible. You can see it, you can almost feel it and touch it. And there's so much information around it that just shows you, you know, how many people talk about the stuff that I'm going to finish talking about today on YouTube, you know, compared to the number of people that talk about indicators and parameters and systems. That just gives you an idea. This is the tough stuff. People don't want to know the stuff, but this is where you got to go. Analysis seems logical. You know, there's lots of numbers, and you know, and the engineers and the computer scientists and the actuaries amongst us just go, wow, look at those beautiful numbers. And it seems like it can predict. It seems like it can anticipate, because when you look back and you apply your analysis and you look at it on the chart and you go, wow, look what happened after that signal happened. It can predict, okay? And then, of course, what what R2D2 does with a thing called lock on, lock out, is it's perceptually blind to the times that it didn't happen. Why? Because you want it to happen. You want the price to go up when you found your holy grail of analysis, that all the times that it doesn't go up, as you scan through the charts, you don't even see them. You are perceptually blind to them because you so badly want that this set of indicators, this analysis, to be the right ones for you to be able to solve your problems, that you don't see the lost trades that happen. You don't see the crevices. They just are vanished from your eyesight until you plug them into a computer and you try and work this out correct to 4 decimal places. And then suddenly you see, what are all these losses doing here? And you click on the chart and you go there, wow, I didn't see that. It seems like it can predict, but it cannot. It cannot predict. It's a probabilistic environment. It's a complex system with endless variables that interact on it. So you feel it must be the way. As I keep saying, the market is a complex system, and these risks will occur, and they'll occur in this environment, this complex system of the market, far more randomly as well, because of all of the variables that interact and change things. So it's impossible to predict, and you have to let that go. You can't anticipate. You have to go down a different path. And at some stage, no matter how good your analysis is, or you think it is, and even if you think you're not a bad trader, eventually some set of variables and circumstances will conspire in this wonderful complex system thing called the market, that it will undo your analysis. And the more faith you have in how good an analyst you are and how good your system is, the greater the fall will be. And the greater the fall is, the bigger the scar tissue will be, and the less likely it'll be that you'll be able to recover from that fall down that crevice. You cannot analyze away threats and risks and the emotional pain they cause. You cannot. You got to just accept that, and you got to find a different way to going down that way. Does analysis have to be part of this equation? Absolutely. But it doesn't have to be the best analysis. I'll put to you what kind of analysis in a moment. So what is the problem? The problem is our ego does the bidding. What does our ego do? It protects, proves, perfects, and people pleases. Now, I'm not going to go into all this in any detail. You can look this up and read about it yourself. This is now Psychology 101, right? So on the protection side, it's got auto threat detection systems and pain avoidant mechanisms that are automatically operating all of the time. You can look this up, and one of the other sources that I have is Atomic Habits, and we pull Atomic Habits apart by James Clear as well. And these things are operating all the time. They're looking for rewards. They're looking for cues that are only going to give us good stuff, right? But the market doesn't always throw us good stuff. It throws us as much bad stuff as it does good stuff. And in fact, you can find periods on the S&P 500 where it's gone up 30, 40%. And there've been 50, 55% down days in a period where it's gone up net. Okay. So what I mean by that is that on a day-by-day basis, an event-by-event, like event basis measured over periods, there's more negative feedback than positive feedback, but the net result is a positive outcome. So we all this negative stuff, this pain that's being caused from down days is hitting us in a far greater frequency in the market than anywhere else, right? What else does the ego protect? It protects itself from change. It defends itself, right? It defends by blaming, by distraction, by busyness. This is too hard, and takes simple things and overcomplicates them. That's what it does, and it's doing your bidding all the time. And to perfect and prove, well, how you're still looking for the Holy Grail? You probably say that to me if I ask you that consciously, but subconsciously your ego is still looking for the Holy Grail. Why? To avoid the risks and the threats. That's what it's trying to do, right? And of course, we won't go into people please here, but are you trading for you? Are you trading for your authentic self, or are you trading to prove something to somebody, to please somebody else? Think about it. Left to its own devices and untrained specifically for trading, your ego will prevent trading excellence. It's an absolute dead cert. So the solution is you've got to reframe. You've got to reframe the threats, the mistakes, the risks, and the fears, and they're ultimately all the same thing. You have to retrain our trading ego. Now, ego, we have many, well, we get into that in a moment, right? So you have to create new skills, new functional and specific skills to trading, right? And you have to de-energize the dysfunctional self-sabotaging thoughts and actions. And you do that by building habits. And the process of going through building functional habits, right, where you become somebody who you transform from somebody who just places trades to somebody who trades properly, who executes properly, and the whole equation of what makes up trading properly. And so you build your authentic self, an authentic trading self, right? And that's what overcomes ego. And if you like, doesn't really overcome ego, it builds an ego that is functional with respect to the activity of trading. And this becomes your functional trading identity. Now, we have many identities, not only just in trading. We'll get into that in a moment. And the solution is, the first step is you got to have an objective edge, a no wiggle room edge, as I defined to you earlier, with a positive expectancy, a positive expectation, a mathematical expectation, or a positive expected value. And then you have to intentionally go into a trading skills acquisition process. What kind of skills? So you can become like the casino, which I mentioned earlier. The casino, it accepts that it's going to lose and have lots of losses and lots of consecutive losses. But it has an edge that it trusts and is confident in and executes it consistently. Now, the player doesn't do that. So you want to become the executor of an edge. So the 5 skills of trading excellence. It's a journey that starts with, at the bottom, of acceptance. Acceptance of what? Acceptance of the risks. Because you cannot, if you continue to try and avoid the risks, right, i.e. not accept them, then you are going to continue going through the whole iterative spiraling, dead-end journey that I've just explained to you in some detail. And so the first step of having a snowball's chance of getting to where you want to get and achieve trading excellence as a trader is you have to accept that those risks are going to happen, not just verbally and lip service, but with every part of who you are, with every part of your trading identity. Accept the risks. And then you have to achieve objectivity. Let's talk a bit about objectivity, the definition. This definition doesn't come from trading. It comes from the world view. So what does objectivity do? It minimizes influence from personal biases and perspectives. It relies on empirical evidence and observable data to draw conclusions. It doesn't rely on subjective opinions, personal interpretations, feelings, or beliefs. Objectivity is evidence verified independently of one's personal feelings. It ensures research findings can be replicated by others. Blah-de-blah-de-blah. Is this familiar to you? Well, hopefully it is. And but even if it's familiar to you, are you doing this stuff? Because this is important. If you want to become an excellent trader, proper trader, you have to do this stuff. In contrast, subjective perspectives are rooted in conjecture, innuendo, surmise, personal perceptions, emotional states, cultural backgrounds, and individual experiences. Any of that sound familiar? Because that's what's not to do. Right? That's the opposite of what you should do. Surmise is about supposing that something is true without having evidence to confirm it. Using any indicators like that, potentially, combination? You have no proof. What proof do you have? The only way you're going to be able to prove it is to work out what combining those indicators together, what the edges of them, correct to 4 decimal places. Without that, you're just surmise, right? Now, I could spend a whole session just on that alone, objectivity. But you can watch the recording and go through those in detail. You can look it up, and none of those definitions come from the trading world. They just come from the general world, particularly to do more with statistics and science. And then you have to trust your objectivity. You have to trust your objectivity, so your edge, You have to trust yourself to be able to execute it. And you have to trust the market, the environment, this complex system in which you are operating, this environment in which you are executing, that it is an endless stream of opportunities, that is going to continue to deliver opportunities in the way that your edge is going to be able to take advantage of it. What is your edge? Your edge is your flow. Your flow keeps you, what is flow? Flow is the now moment. It's not looking at the past and associating with past mistakes or past bad outcomes that you don't like, that your automatic threat detection systems are highlighting to you. And it's not trying to anticipate and predict into the future, because when it does that, it tries to avoid what it doesn't like, right? If you're in the flow and you're executing your edge, you're in the now moment. And when your edge presents itself, you execute it with no hesitation or reservation. And that's all your job is to identify when your edge occurs. That's all it is. End of story. Buy, what to buy, when to buy, how much to buy, and when to sell. That's it, period, no more. And you've got to trust the decision support system that you have in place with an edge correct to 4 decimal places, that it's going to play out regardless. Consistently execute it, it's going to play out regardless of what happens in the market. Because the market, your edge is going to take care of that. And then you build confidence. Confidence doesn't guarantee the outcomes that you want. What it does do is it guarantees that you're going to execute your edge like it should be. And you're going to focus on the fairway and not the water. You're not going to focus on the Holy Grail. You're going to see the path in front of you, and you are going to be able to handle it. And ultimately, that leads to consistency. And that's what we want to achieve, because we can't achieve perfection. We can't achieve the Holy Grail. And we know that because at the very bottom, we've accepted all the risks with every part of who we are. That is who we are. Now we are building a trading identity. But nobody's born with these skills. These skills are learned through lived experience, through actions, through doing things. And what we got to do is get off the trial and error, by the seat of our pants, on the fly type environment. And we've got to get scientific about this. And then we've got to make those skills strong and unshakable through practice and repetition. Skills cannot be downloaded. They can't only be read about and suddenly put into your head. They can't be instantly attained and just chucked in there. An awareness of this is only the start. So for a lot of you, being aware, what you're hearing today is only just the awareness part. It's just the start. And if this is challenging and you think there's a load of crock, the greater the degree to which you think that I'm saying here's a load of crock, is the greater is the degree to which you will fail in achieving any kind of trading excellence whatsoever. This is the game is all about. And if you are rejecting it, that is your ego is rejecting it, your subconscious is rejecting it, that's your belief system rejecting it. Well, then what? I'll just put a question to you. Do you know more than Mark Douglas and what he taught and what he learned and trading, coaching traders that handle $100 million accounts? Do you know more than him? Do you know more than James Clear and about building habits? Well, if you're rejecting the material I'm putting to you today, then you are saying you know more than them. Well, just look to your results. Look to how you're doing. Because at the end of the day, your actions and your results are what reflect what your identity is, your trading identity. So skills acquisition, think of practice techniques for violin, golf, team sports. The way to practice in trading is the same way as you've learned to practice in other parts of life, right? Mathematics, bridge, poker, you take it, right? Individual games, tennis. It's about stepping into a skills acquisition process. And these skills acquisition, these skills that happen in our mind, in our head, all of those things, the pyramid I put there are all in our minds. We've got to do this. And you have to practice the same actions over and over again. You can't, by definition, practice something that's different. It just confuses the brain. So if you're using, a different entry signal based on different parameters and different sources, like I heard this here, tip there, read an article there, broker said this, mate said that, and those define all your entry signals. Well, that's not practicing. You can't practice that. And how can you replicate that? You can't take that set of whatever the order of what those, even if there were some good trades, good trades can happen. When I say good, profitable trades can happen out of pure luck, out of pure randomness. The market's going to give you that. It just confuses the brain. You can't practice something that's different all the time. You got to play something correctly as many times as you can, but you got to define correctly. And I defined correctly to you a bit earlier with Mark Douglas's definitions of entry and exit. Your brain doesn't know what is right or wrong. It'll just memorize whatever you do. Don't practice something until you get it right. Practice until you can't get it wrong. You must objectively define wrong. What is wrong? Wrong is not a lost trade. Wrong is when you don't follow your process according to the rules. That's wrong. So now you've got a different definition. We started reframing what wrong and right are. They're not profit and loss. They are how well you execute, because trading is a function of execution, not of your analysis. Once the analysis is done, right? The analysis is done once you have your edge in place. That's the beautiful thing about it. Like the casino, the edge is done. It's in place. They've worked it all out. Now they've just got to execute it. So get an edge that has a positive mathematical expectation. The analysis is done. Now you just execute it like a casino. You want to get to the point where your brain won't let you play it wrong. It becomes a habit, right? Now, those all put in quotes because I found those not for learning how to trade, but for how to play a violin, how to learn to play a violin, right? And the same stuff happens. Why? Because it's the same brain. You getting it? The easy way to do this is to use the 10 times rule. Practice it 10 times in a row with no mistakes. If you make a mistake, you go back to the beginning and you start. I went for a putting lesson about 3 or 4 months ago. And Marcus Fraser said, you go over here and you line up the putter and you get a feel of where your putter faces, and you sink 10 in a row, right? And then once you've done that, you go back a bit further and you get 10. And if you miss one, you go back to where you were. So you started a foot, you go to 2 foot, 3 foot, 4 foot, 5 foot, and you get 10 in a row. And when you miss one, you go back a foot, you go back a step, or you can even go back to the beginning and start again. That's how you practice it, to not make mistakes, and you're training your brain to execute. What's a mistake? Breaking your rules. If you've got no rules, then there are no mistakes. It's wonderful. Come to the market. This open, complex system can do what the hell I like. The only rules are it opens in and closes in, and that's going soon. And you can do what the hell you like. There's no rules, right? It's a wonderful feeling until all of those risks start happening, and your outcomes tell you, how you're doing. So you've got to define what a mistake is. Can't repeat 10 times in a row, mistake-free. Slow it down. In trading, that's less risk, smaller position sizes, smaller portfolio value, no leverage, and less trades, therefore a longer term system. Slow it down. It happens, it's called deep practice. So slow practice equals fast practice. And now they've even done scientific research, all this wonderful stuff that's come out in the last 10, 15, 20 years where they can wire up our brains. And this is what James Clear's done in Atomic Habits. He's got all of his stuff is scientifically backed up, right, by human experiments, where they can see what's happening in the brain when certain things happen. And slow practice equals fast practice. They've now proven that violin players and piano players and all these people learn when they practice in slow motion. For every 6 minutes they practice, it's like practicing for an hour. So they're getting 10 times more benefit they're getting the same benefit in a tenth of the time. And you can do that with anything, because that's how you build myelin. We'll talk about it in a moment. So practicing too fast for the level you're at will guarantee mistakes. And the more mistakes you make, the greater, hopefully you learn from them, but you could be practicing the wrong things. And that's what you have to work out as well. So make too big a mistake will be too big a disappointment. The more difficult it'll be to attain the skill when you've got too much emotion invested into the mistake you made. And because it creates a greater scar, and therefore it's more difficult to heal. So playing when you're scoring under pressure, right? So this is about, if you're playing to score, i.e. to trade, to make profit, and you've got too much at stake, right? And you haven't done the practice, then you may be going too fast for your skill level. So you have to work out, for your skill level, what is, and then I'll give you that action in a moment, but just don't go too big too early. So you've got to practice in pieces as well, small and bigger, difficult parts, practice entries and exits and position sizing. And then you build all the parts and you put them together and you aim at your target speed, which is ultimately your portfolio size. So practice doesn't make perfect. Perfect practice makes perfect. So you have to make sure you're practicing the right things. And at the moment, if you're not in a skills acquisition process where you are practicing acceptance, objectivity, self-trust, and trust of the market, and confidence and consistency, then you're practicing the wrong things. So if you're practicing subjectivity, different entry signals, different sources of why you should buy and sell, then you are practicing subjectivity, which means that you're not getting better. You'll just stay where you are and you'll never, ever get to where you want to go. So how do you, quote unquote, from Mark Douglas, flawlessly execute a trading system that has an edge, right? Flawlessly execute a trading edge. That's what perfect practice is when it comes to trading, something that's repeatable. And then you build functional habits. So repeated action equals strong neural pathways. Read the book, The Talent Code by Daniel Code, and he talks about look up myelin. Look up myelin sheaths, and you'll find out all about it. It's effectively where skill resides in the brain, and you've got to be building up this myelin. You cannot repeat something that keeps changing. You cannot repeat subjectivity. Eventually, if you are repeating the same thing, it becomes automatic and a part of your identity. Habits are the execution excellence of engine of excellence. What a great quote. Habits are the execution engine of excellence, not analysis. Analysis is not the engine of excellence. So think of dashboards. Think of your businesses that have all these wonderful analysis data dashboards, and so what? Unless you take those and turn them into some functional action that you execute, the dashboard is worth nothing. Think of sporting teams' plans. Can be the best plans laid out. Unless you can execute them properly, it doesn't matter. It's all about execution. Your trading identity controls you. So we have many identities across relationships, health. You even have a different identity with different people that you interact with. You'll have one identity for that group of friends. You'll have another identity for that group of friends. Why? Because you met them in different places, and you're a different person with them. That's a different ego for every situation. You have different identities for health. Well, don't want to go there, might be a bit touchy, but your outcomes are a manifestation of your identity, who you are in that particular area. So your actions and results reflect your habits, and this is your identity. So whatever actions you're doing, whatever results you're getting are a reflection of the habits you have. Are they functional or dysfunctional with respect to what you're trying to achieve? That's your identity. Your identity also is what you believe to be true about your environment. So right now, there'll be people listening to this where they have a totally different truth about this environment, this complex system called the market, and how to become successful in it. And that'll be your identity. And I'll be challenging your identity, your ego, with respect to that right now. And your ego will be defending itself. That's what it'll do. And in defending itself, it'll blame, it'll distort, it'll forget, it'll whatever. And you'll leave this session today, and guess what? You'll say, too busy. I've got to do this over here, which is of a lesser and lower priority than what I have to do in my life compared to this. But you're justified doing nothing, no action, right? And that is because of what you believe to be true about trading. The nature of trading is totally different to what I'm telling you. And you're getting hit right between the eyes with it. And it's challenging you, and your ego hates it. And it's going to do whatever it can to defend itself. So what is transformation? Transformation is identity reshaping, and with respect to trading. This is not about changing your whole personality of who you are as a human being. It's just this one with respect to trading. And somewhere along the line, there might just be enough pain or something that's happened to you in your trading experience where this will resonate with you, and you'll say, okay, this guy's not talking a load of crock. I'm going to do something about this. What do I have to do? Well, I'm getting to that in a moment. I just want to dispel a myth that people say, find a system that suits my personality, find a system that suits your personality. And you get a system and, no, it doesn't suit my personality. Go to the next system. No, it doesn't suit my personality. Because obviously your personality is right. It's the right personality. It's the right identity for trading. It must be, because you know everything there is to know. And that person over there that's doing way better than you, well, what does your ego do? It justifies why they can do it and you can't, and it blames this over here as to why you can't do it, right? Defending itself, protecting itself, right? So I'll put to you, that's just a system hopper. You become a system hopper, filling in that myth. I've heard it a ton of times. It's a load of rubbish. It's got nothing to do with finding a system that suits your personality. If you have a proper trading identity, you'll be able to trade any edge successfully, any edge, whether it's intraday, whatever, as long as it has an edge. If you are prepared to put in the time that's required of that edge, you'll be able to trade it with the right trading identity. And that's what you have to get right, not the right system. You'll never find the right system to trade your personality, because, wow, every personality is a human being. We are unique. So what is there? Is there one unique system per personality in the whole trading world? Absolute rubbish. So most traders never build these skills. Why? Because they're concerned too much with technique rather than practicing technique. They're concerned too much with analysis, right? Because analysis is going to solve their problems rather than how to practice properly. and their system isn't objective and repeatable, i.e. it's not mechanical, it's not rules-based, it's not non-discretionary. And if you can't repeat it, then you can't develop skills, whether that's trading and every other part of life, whether it's learning the piano, the violin, how to play tennis. You have to be able to repeat it. So there's a certain technique, and you have to be able to repeat that. Right. Two players there. One is the best golfer that's ever lived, and the other one was an okay golfer, but recognized as the best putter that ever lived. Which one do you think is the best golfer? Which one looks the worst? Well, that's Jack Nicklaus on the left. Yeah, in all my 51 years of playing golf, I've never seen anybody with a putting stance like that. Yet he is the best golfer that's ever lived. Right. So the point I want to make here is that it's not about technique. As long as that technique has an edge, it's about how you execute that technique. In putting or hitting the golf ball, it doesn't matter. You've seen the most ridiculous swings, the most ridiculous techniques. Ball goes down the middle. All that's got to happen is somehow, whatever the technique is, has got to conspire that at the time the club face hits the ball, it's square and it's going at a certain pace. So what brings that? It brings it? Rhythm, tempo, flow. That's what brings it. The rest of what happens over here, it doesn't matter. There's been some funny swings and professionals that people still laugh about. They're making a lot of money and made a lot of money. Why? Because they had flow, they had tempo. That's what they have. And that's what an edge is in the market. It's your flow. It keeps you in the now moment. It takes away the distractions of associations to the past and the predictions and anticipations of the future, and you execute now. Why? Because you trust it, you believe in it, you have confidence in it, and you have got a mindset that allows you to execute it consistently. So objective system equals skill development. Mechanical rules remove subjectivity and variability. The same trading decision criteria every time makes the practice possible. If you haven't got the same decision criteria every time, you can't practice. It's just by definition, you can't do it. Yeah, you got to have a system with an edge that is repeatable and objective. Right, the practice routine. So here we're now getting to how you go about this. This is the tangible stuff, the exercise, if you like, right? So what you got to do is you got to practice how to get these skills, and you do that with a small, slow portfolio size to build skills and habits. So this is about skills acquisition. It's not about profit acquisition. And we used, and this is what we do with our customers, and we used the exercise in chapter 11 of page 189 of Trading in the Zone, where Mark Douglas talks about doing 20 trades and lots of 20 trades. Well, we've taken that a step further. But to do this, you have to have an objective, rules-based, no wiggle room system or signals to buy and sell, and money management as well. And I gave you those precise, absolutely precise definition that Mark Douglas put to us earlier, and that's what you have to do, right? And then you have to create an obstacle course, right? You think about, we go to other walks of life here, how do the trained Marines in the military, what do they do in basic training when you go to the military? What do they do, with teams, right? These days now, I've watched videos of how the best rugby teams in the world, and Paul's probably listening to this, and it's not his team, is they practice passing sitting on the ground, right? And then they practice on their knees, and then they practice standing, and then they practice jogging, and then they practice, and so it goes faster and faster and faster. How do you learn to tightrope walk is an analogy I've been using for 20 years. And Dave used one with our customers on Wednesday, is that you start slow to the ground, close to the ground with a slack wire, and then you make the slack wire narrow, and you go up. It's the same with everything, and it's the same with trading. Human beings can't just go from there to there in one iteration. We have to do it slowly, and it's the same with how we learn to trade. To get these skills, these mental skills that I went through earlier in the pyramid, you have to start slow, but you have to create an obstacle course to test you, to test acceptance of risks. Because if the risk is too big for the level that you're currently at, you're not going to pass the test. Do the 10 times. Do it slowly, right? Start with longer term, then you go shorter term. Don't start with 400 to 1 leverage, in 5 minute bars. It just ain't going to happen, right? The mistakes and the pain are going to be too great for you to be able to get back on the horse. What do you fear the most in the real environment? What do you fear the most? And typically now, with having coached people for over 2 decades and had the benefit of Mark Douglas mentor me for 11 years, is if there's one environment that people fear the most, it's drawdown. Whatever conspires to cause drawdown, they fear it the most. And even if they have followed their rules and traded precisely exactly by the system, even the best system, and I can give you examples of best systems in a moment if you want, but the best systems will all fall when you get a correlation to one in financial markets, as happened in 2008, where you had the best hedge funds in the world making astronomical profits, pulling plugs out of the wall to turn their computers off. That causes drawdown. Point there is, no matter how good you think you are, you'll never know what's going to happen next, and you'll never be able to avoid drawdown. Impossible. So if you can't avoid it, and told you earlier about what effects happen in your brain if you try and avoid something that's unavoidable, how do you deal with it? Well, you have to learn how. You have to train yourself. You have to gain skills. You have to create the obstacle course to go through your worst fears, and you have to experience the fear. Then you have to come out of the fear by executing, not by stopping and running away. That ain't going to help to actually get the skill. You have to become comfortable with being uncomfortable. And you have to do that enough iterations until it gets there. But you can only do that if you have an edge that you trust. So there's the 10% drawdown challenge. So you trade, but you must be trading with an edge that through research, back testing, whatever, has the numbers correct to 4 decimal places, that you have an edge, and then you execute. And you execute until you go into drawdown, because this is what you want. You now are in the obstacle. You're feeling it. You're in the middle of it. You're living it. And the sweaty palms start happening, the sweaty upper lip, the thinking, stopping thinking about other stuff and just thinking about this drawdown and losing money and red ink on the screen. All of that happens, but you have to go through it. And then you have to not flinch. You have to continue executing consistently, without hesitation, without reservation, and you come out of it, and you make a new high, and you do it again, right? And you go through that iteration. And we put the challenge is to go through two of at least 10% drawdown. In my view, the more that you go through and the greater the drawdowns, if you can get to 20, 25, even 30% drawdown, because it's going to happen, particularly in leveraged markets, you grow the myelin, you grow the experiences, and you build the skills. And what are the skills? The 5 skills I went through. So you got to practice not flinching under pressure in the real environment, realizing your worst fears and all of those risks. So you start accepting those risks. You start being objective because you've consistently executed the same system, the same processes, the same signals. And then you build trust. And then from trust comes confidence. And from confidence comes consistency. That's the way to do it. And while you're doing this, you journal to prove to yourself, right, that you're not hesitating, that you're not skipping, that you're entering, that you're not doing all of these things that are the risks, the manifestation of the risks. You're not seeking information. You're not going off to other sources to see whether you should or shouldn't follow the signal. You are looking at mistake manifestation. This is about mistake minimization with a well-defined what is a mistake. And the mistake is not following the rules, not following the process. Easily defined, it's not a debatable subjective point as to whether it was a mistake or not. Well defined. And you document everything that you think, feel, say, and do in the moment at every transaction. And you repeat that with every trade. With every trade, and this is what we get our customers to do, is to repeat the 5 fundamental truths. That's why I repeated them to you verbatim at the beginning of the session. There's no notes here. Been able to do that for 20 years. And the 7 principles of consistency, because these gauge, so there's truths and principles that you are subscribing to. There's some science here, and this is all backed by James Clear in Atomic Habits. It's amazing how much they confirm each other, right? Written by 2 different people, never met each other, none of them Boris Soap, from 2 different, totally different sources, one scientific, one from practical experience and learning himself, and also coaching people, and that say exactly the same thing. So if all of this is a load of crap to you, you're basically saying that Mark Douglas and James Clear are not good enough. That's what you're saying if you think what I'm saying is a load of crap. And you can build other affirmations if you want. You can build your own affirmation cheat sheet, and you can just say it, whatever. Literally, you can go through it in 30 seconds. You've got 30 seconds for every trade to do this, to build a new identity, a new ego with respect to trading. Does it take effort? Well, it does take effort, because your current identity is going to defend the hell out of itself. It's going to stop you from doing this stuff. And the same as what you have tried to do, get fit or change diets or do whatever. Why is it so hard? when the actual actions themselves are not that difficult. It's hard because R2D2 is defending itself. Current beliefs, current habits, current ego defends itself. It's a natural trait of your ego, current ego, to do that. So it will continue to self-sabotage you until you retrain it. Public proof. I've traded a bunch of portfolios, but I've traded 2 public portfolios since January 2016. 100% question mark objectively and consistently under public pressure. I can't claim that it's been 100%, but it's near as damn it. But the intention, the aim has been to be 100% mechanical, rules-based. And I've made some mistakes, like missed a day here and there. I made 2 fairly large mistakes with the US portfolio, which I won't go into now, and they've had quite a big effect on portfolio. Still averaging 12% compounded per annum, but not as well as it could have done. Right, I know that because I can test that against the mechanical system of if I hadn't made those 2 big mistakes. And those mistakes took quite a while to play out, months to play out, and had a negative effect on the portfolio. But I can test that because the mechanical system, I can go back and see if I'd taken those trades, this is what would have happened, right? So the ASX portfolio over 9.5 years now has trebled, much better than the ASX 200 accumulation index. And the US portfolio has nearly trebled in US dollars. This is real money, been trading, trades all out there, transparency, 30% loss trades, 100% profit trades, all in there. And but with currency variation, I've tripled my Australian dollar, more than tripled my Australian dollars over that period of time. If I had to convert on the 30th of June this year to US dollars, to Australian dollars. So there's public proof in this, and I follow these. What I'm saying here is what I'm preaching is exactly what I practice, right? I claim to be 100% mechanical, rules based, and all of those skills are what I've worked on, what I started working on years ago to do. And I floundered and I came up with different ways and I stopped and I started and I did all sorts of things. But ultimately, for a long time, Mark Douglas kept me on the path as kind of my coach and mentor. And I spoke to him about all of this stuff. And but what you should be doing is, and I'll give it to you in a moment, is finding somebody that can play that role that Mark Douglas played for me. So there's another definition of expectancy. So what I'm saying to you is that expectancy plus consistency drives results. That is the name of the game. That is the key to this whole thing. And so expectancy is edge. And there's a slightly different variation of the formula. It gives exactly the same answer as the one I put to you earlier. So this is the expectancy of the edge on the ASX. And what I've done over here is I've taken it over 20 years, broken it down to over 5-year periods. And this is the worst 5-year period on the ASX over the last 10 years. That's including, but anyway, so the win rate, 50%. This is before costs. So we're taking a raw naked edge here. Costs make this slightly worse, but the results I showed you over there are including costs, including dividends, excluding franking credits. So franking credits could make the result a little bit better for the Australian market situation. USA is a better edge, and compare that to American roulette with a double zero of 0.0526. By the way, European roulette with a single zero is half that, nearly half, a little bit nearly half that. 0.027 is European with a single. So even a skinnier edge, but they still make tons of money, right? So payoff ratio is average win divided by average loss. Win rate, you plug that into, you get these expectancies over here. So how do you relate? What is this expectancy? What is the difference between these two? Well, obviously a roulette table, they're spinning every few minutes, for many hours of the day. So you can get away with a skinnier edge. So how do you relate that to trading? If you're trading intraday many times a day, you can have a skinny edge, and you are going to have a skinny edge. Why? Because you're not allowing the market enough time to move. You're not going to get 30% moves in the market in the few minutes unless you highly leverage it, right? Which is why people go to that edge of they're greedy and they're hungry and they want to go and do it all without the skills. That's why they get smashed. But a bigger edge, you can take less time to do it. So you got longer. So these average hold period of these trades is 4 months. So this is really slow compared to what's happening in a roulette table. So there's a connection between expectancy and ability or to trade, the frequency of trading. We won't get into all that now, but just explaining how edges turn into profits. This is an equity curve of the ASX public portfolio that's been going for 9.5 years. And I'm not going to go through any detail except to say that it's had at least 10% drawdowns in its 9.5 years. And it's trebled in value, and it's done 203% total profit compared to the ASX 200 accumulation index of doing 135. So it's quite massively outperforming the ASX 200 accumulation index on on the edge that it has, excuse me. So what do you need to practice? You need to practice these. I've said them a few times, and you need to put yourself into a place and an environment that you can do that. So you can practice drawdown and discomfort resilience. If I can put it into 3 words, just drawdown and discomfort resilience. You've got to become resilient against those two. And what do you need to practice? You need to practice flawlessly executing your trading system. No wiggle room. That's straight out of Mark Douglas. That's a quote. Flawlessly execute your trading system, your trading edge, your objectivity, with no wiggle room. What tools do you need? Well, you need a rules-based edge, for the mechanical stage. Earlier, I said Mark Douglas calls this the mechanical stage, and you can then go to subjective and intuitive after that. We won't go into that now, and you can explore that in his material. But you've got to start with the mechanical stage, like you do with everything else in life: brushing your teeth, riding a bike. You've got to make edge identification easy and efficient. James Clear tells us that if you want to build a new habit, you've got to build in an environment that makes it easy for you to do. Why? Because you don't want to allow your ego to easily defend itself and blame something and stop you from doing it. So you've got to make it easy to break down your current dysfunctional habits and your dysfunctional ego with respect to trading. So you've got to make it easy. Identification easy, tools easy, all that sort of thing. And you've got to make it efficient, not something that takes up your whole day. So I'd put to you to try and learn these skills. Intraday trading is not the good way to start. Especially with leveraged markets. If you really, truly, and with intention and you deliberately want to try and gain these skills, then you do it easy and long and slow. You've got to create a skills acquisition plan. You've got to have a portfolio manager. Why? Because this is rules-based. So you've got to look at rules-based trading system edge type metrics to see how you're doing in terms of your execution, how well you're trading. And you need a portfolio equity curve, like I just showed you there. You need a motivator and an accountability buddy, right? A spouse, a friend. Why? Because everybody needs a coach. Tiger Woods, Jack Nicklaus, they all had coaches all the time, right? Why? Because these people are soundboards looking on from the outside. Doing this yourself, where it's just you and your ego, and it's the very ego that you are trying to reframe. It's going to stop you from doing this. So you need some outside assistance. You need a coach, a mentor, or whatever. Look around through the ATAA. I'm sure you guys can buddy up and do this sort of stuff if you really want to, and keep each other honest and check with each other. That's the role that we play for our customers. But if you've got a trading system or whatever that or mechanical edge that has an edge, then buddy up, find somebody to do it. And of course you're already saying at the outset, we're going to do it with a small amount of money. So you're not divulging your whole financial asset base. You're doing it with a small amount of money. You agree what it is, buddy up and do it. It's I promise you, it is amazing. It's transformational. The feedback that we get for people that have struggled for years, like years and even decades to crack this caper, are just giving us unbelievable feedback by going into the skills acquisition process. So are you the punter or are you the house? Which one do you want to be? Which identity do you want? The one that flinches and is always unsure and predicts and associates and has that identity that's doing their bidding for them, that does it for them automatically, that they will never stop doing unless they undo that current identity and build a new one? Or do you want to be the one that executes with confidence and consistency, with calm, with and at peace with all outcomes? I haven't used the word peace today. How have I done that? But it's all about getting to that calm, content, peaceful, and not feeling that angst and anxiety and the stuff that gets you to make mistakes. Which one do you want to be? So the feeling of trading excellence is calm, objective, confident, consistent, no noise, no commentators, no opinions, no surmise, just focus, just on what you're doing. And that's just trading properly. And that's how you get to habitual profitability. I've hardly mentioned profit today. Why? Because skills come before profitability. You can't just jump in this caper straight to profitability. And the more you try to chase the end game without the stepping stone of skills along the way, this is the degree to which you're going to fail. Final reflection: stop hoping, start profiting. And this is the great little quote that I've come up with. You don't rise to your level of analysis. You fall to your level of mental skills and habits. So whatever your mental skills and habits are at the moment is the level that you will continue to operate at. And when the market really gets tough, they get found out. Some sources for you, which I'll leave on the screen, and they're just the ones that came to mind. There's tons of sources over here, which have all played a role, including mentorship with Mark Douglas along the way. So time for questions. I said an hour and a quarter. I've gone about 9 minutes over. Right, some questions. There's one from Graham. Can trading edges deteriorate over time? How do you know when trading systems that you have traded with excellence need to be reformulated? Okay, great question. And this is one that people come up with all the time, right? So your edge needs to be continuously be re-researched. And when I say re-researched, it's not from scratch, right? So what you need to do, and without going into the whole theory of, there's now, when 30 years ago when I started the ATA, talking about mechanical systems was like, couldn't go there. Whereas now there's special interest groups that go into detail about AmiBroker and all sorts of stuff. So people are getting there, right? But the point that I make over here is that people overdo it. You don't need to have an edge that is so perfect and great before you trade it. So do edges deteriorate? It depends on the concept. So what you got to do is go back to the concepts. If the concepts are sound, the indicators are sound, right? So the logic is sound. The answer is no, they don't deteriorate. And the one that I've been using for some time over here now, and even the one that I originally put out in 1998, the edge is still there. It's unbelievable. We haven't touched it for 13 years and the edge is still there. So it's a lot more difficult to trade because it's a lot more frequent. But what do you do about your edge? Do you just leave it like it is forever and never touch it? No. So you got to re-optimize, and that word optimize is one that it probably needs a whole session on its own, because the big thing with optimization is that you curve fit and you over optimize. So you got to keep your degrees of freedom loose. But what you do is you take new sets of data and you can do walk forward analysis and back test over in sample and out of sample data, and there's a whole science to it. But if the concepts are solid, your edge will still remain present, right? But what you do is and if you've got a longer term edge, which is the one I use all the time now, is I re-research, not with a view to throw out the concepts and come up with new concepts, but just to see if there's any tweaking that can be done with the parameters. And the current edge that I use, I do that every 3 to 4 years, 5, depending on market circumstances. If you had 5 years of raging bull, it's not going to help to re-research the edge. If you had 5 years of just down, continuously going down to 8, not going to help. You really want to have new data that gets added to the data set that has at least an up and down market of at least 20%. That's really what you're looking for ideally, and then you can re-research in there. But the actual movement of price action, I take stuff now, and I've got access to data through Richard and Norgate, going back to the 1950s, wonderful stuff, right? And I go to the really liquid stocks and just got to eyeball the data and make sure that it's, that it's not straight lines and stuff like that. So stocks like IBM or whatever. And I take the system now that in the last 10 years and the results I go back to 1951 to 1965, and I check it, and you know what? It's there or thereabouts. It's still good enough. So what do you learn from that? That human beings haven't changed that much. That's really what you're learning about it. It's not the market that's changed. It's a complex system. It's what makes up the market, and it's human beings, and we haven't changed that much. All of these foibles I've gone through today are there in all varying degrees, and we're there back then as well. Okay, so another one. How can you build confidence in a constantly changing market? So now the constantly changing market is a given. It's a given, right? So what that issue that you've got there is you use the word confidence, but what are the steps before confidence? Trust. What is trust? So it's trust your edge, trust yourself to be able to execute your edge, and trust the market. Trust that the market is an endless stream of opportunities. And for you to not so that statement is saying that there are never going to be enough uptrends available for me, for my edge to be able to profit from. So you've got your issue there is not one of confidence, it's one of trust. And so where does trust come from? What's the layer below that? It's objectivity, right? So you have to go and build something that you can trust. So, and what you're saying is, I'm not going to trust my edge because I don't trust the market. So the thing that you don't trust there, that you've got an issue with, is the market. So what I'd suggest you do is that you go and do just what I told you there, right? Just what I said there, is take an edge, take a simple one, take, just crossover moving averages, whatever you want. The one that doesn't take you too much time, doesn't have to be perfect. There's an edge, it's a skinny edge, but it's there. And get access to data from Richard and the historical databases that go back. You might have to pay a little bit of money, and go and take the stocks that were available in 1951, the Raytheons and the IBMs and the ones over there, and and take that moving average system and build it together on 10 years of Amazon data, Facebook data, right? And then go, oh yeah, this little edge I got over here, let me go and run it on IBM and Raytheon and whatever, the ones that were around in the 1950s and 60s. And what you'll do is you'll prove to yourself that the market is not constantly changing so much that you can't build an edge. It is, but what that is, that question, thanks for the question, that's R2D2 defending itself, coming up with a reason why something won't work and blaming something that's kind of out of your reach. And you've applied some logic that says, too hard, mug's game. Okay, how do you build confidence? So hopefully that answers your question, anonymous attendee. There is, you can prove or disprove anything you want in the market through subjective technical analysis. Think about that. You can prove or disprove anything you want in the market. So why did you rather go and prove that the market is an endless stream of opportunities? Because they are there all the time, day in, day out. Peter's asking, does the stage of the market currently pretty mature affect the way you operate? Okay, so there's a number of things that could mean. So does the stage of the market currently pretty mature affect the way you operate? So I'll break that down a bit more. So at the moment, we're in a secular bull market. Secular bull markets go for 13 to 20 years. We've only got a small sample going back to if you go back to the Dow Jones 1896, we had secular bear market. We had secular bull market through the 20s up to 1929. Then we had secular bull market up to 1920, secular bear market from 1929 through to 1949, 20 years. Then we had secular bull market, 49 to 65, secular bear market, 65 to 82, and then 82 to 2000, secular bull market. Then we had secular bear market, 2000 to 2013, and now we're currently in a secular bull market, right? So the question is, and that's the 17 to 18 year cycle, and there's longer term cycles and shorter term cycles within those. Bull and bear, secular bull and bear, you have primary bull and bear markets. And so currently I'd say we're in a primary bull market in a secular bull market. Traits of secular bull markets are that they seldom have drawdowns more than 20-25%. Secular bear markets have 50 to 60 to 80% drawdowns, and I'm talking about indices here. Stocks go more than that. And also secular bear markets don't make new highs. They don't have new breakouts. Secular bull markets, for significant trait, have new breakouts to new highs. So currently it's mature. When I say mature, I'd say we're at least 2/3 of the way through the current secular bull market, with anything from 1 to 6 to 7 years to go. How do you operate in that environment? Have an exit signal. End of story. You have an exit signal you trust. What you can't do is say the market is too mature, therefore I know what's going to happen. It's going to fall soon, and I'm going to sit on the sidelines and do nothing because I know what's going to happen. So what I would say to you is, don't have a buy and hold ETF strategy in ETFs or any funds at this stage of the mature market, if you like, because at some stage, even if it's a wide stop, even if it's a simple percentage-based wide stop on your index ETFs of say 25%, even 30%, you'll get out and you'll stay out for some time to come. You're going to have to have a re-entry signal then though into your index ETF, but it'll probably be 10 years away. But you can't say, I know what the status of the market is, therefore I know what's going to happen, and therefore I'm going to sit on the sidelines. Can't do that. So So what do? You come up with a technical analysis, an analysis strategy that will save you at the end of a mature bear market, and you put that in place. And you got some wonderful. You can go to 2008 and you can go to 2001. Two wonderful environments, periods in the market where you can come up with something that's pretty simple and is wide enough to save you from the aches and pains that come from a 50%, 80% fall in the markets. Hopefully that gets it, Peter. But don't use it to justify sitting on the sidelines. Okay, you have mentioned secular bull and bear markets. How do you define those, and what is the based on that, please? Gee, I think I've just answered that one without knowing it. But I could show you. I'm not going to pull up the chart now. I can show you the chart. It's pretty obvious. If you pull up, the Dow Jones to 8096 or the S&P 500 to 1926, which Richard will provide you with if you ask him nicely. You can just using simple support and resistance zones with a little bit of a trained eye and technical analysis, and you'll pick them. They're not difficult. Okay, what else have we got here? You mentioned you've been through 10 times 10% plus drawdowns in the last 9.5 years. Do you scale down your trading when in drawdown, or just keep trading as you did before? Keep trading as I did before. Having said that, we are doing a lot of research on equity curve risk management at the moment. We've gone down a number of dead ends over the last 3.5 years in trying to use external market risk management techniques, systematic risk techniques, and every single one of them make the edge worse, which is a good thing, because that's what you should expect. You put in a stop loss that's too close, edge gets worse. Put in a profit stop, edge gets worse as you measure edges, right? That's just the nature of it. So the idea is that you want to have a low number of degrees of freedom, and with fairly wide parameters. If you've got a good concept, then that's what will happen. You'll have few degrees of freedom, and those degrees of freedom on its own will allow you to trade better, to get better results. Problem is that some people want shallower drawdown. So there is a technique that we are researching at the moment, which is running phantom equity curves alongside your equity curve, whereby you continue to trade when you hit a certain parameter in your equity curve, where you stop trading real money, but you continue to trade a phantom portfolio. And the tools required to do this are quite challenging and sophisticated, but that is an avenue that so far that I'm seeing is reaping some quite good results. But we need to build the tools to do that, and you need to build the tools to do that. But so phantom portfolio. But the trading that we've done there, to answer you, no, that's just all degrees of freedom running full out all the time. The exit signals take you into cash. So we've been in that 9.5 years in both US and Australian market, we've never been 100% in cash. I think we've got down to one open position, 9 or 10% invested is the lowest we've got to. So the system just operating it by itself does that automatically. Right. Can you please elaborate the 10% drawdown challenge you mentioned 2 times? Is it cutting down your losses below 10%? No, it's not. So it's allowing, so that question, in fact, what I did there is you allow all the degrees of freedom of your edge to continue running. And then in a period of market downturn, because you can't get 10% profits in a 10, you can't get your portfolio overall to rise by 10% when the market's falling 10%. Whether you and this is a trend following system, which I've tried all other kinds of systems, this is the best. And you can read Mike Cavell, trend following is a whole bunch of places, turtles, there were just that one, the Curtis Faith, the way of the turtle. Trend following to me is the best. I've been doing this for 35 years. I've tried all the others, intraday, short-term, leveraged, shorting, you name it. Long trading long using trend following is the highest probability way of making returns that outperform the market with acceptable drawdowns. Okay, that said, so how do we do this? So you're trading long and you continue to execute your portfolio. You define your portfolio, somewhere between 5 and 15 open positions. And your edge will define when you buy, when you sell, how much you buy. and then you just trade it, right? And when the edge is either out of sync with the market, or the market is falls and the edge falls in sync with the market, you will get to a point where your portfolio value is 10% lower than the highest value it's reached in its life. And it falls and it comes down by 10%, that's 10% drawdown. You change nothing. All you're doing is following the exits. The exits will take you into cash. At some stage, the market will turn, your edge will get you back into the market. You'll continue like that. I'll just go to this slide to rather than try and explain with my hands and without, I'll use a picture, and we'll go there. So effectively, you continue to execute, and this is the portfolio equity curve, and you get down to at least 10%. But if it goes more, you keep going, and you don't flinch, you keep executing your same edge. Eventually, buy signals will occur, and then the edge will bring you out of drawdown to a new equity high. It'll then carry on, take the right-hand side over here, plonk it on the left-hand side. You've got a whole lot of equity curve that's come along over here, like this. I might as well show you this. There we are. So 10% new equity high, 10% new equity high, 10%. I don't know, there were more than 10%. That there was 14%. New equity, keep going. I didn't measure these because they weren't 10%. 10% new equity high. But each time, and this is 9.5 years, when you get into these periods over here, they last for 2-3 months. And in 2 or 3 months, you're a drawdown. Now you have to continue executing consistently with confidence, with trust, objectively accepting all the risks. And when you do that, that's what happens. You come out of drawdown. And so you then go into, and you just keep on repeating that. So that is how, so you're not cutting losses. Your losses are being cut anyway, just by your edge. You're not trying to do something that's different. You're not changing your indicator. You've got this written, you've got the entry rules, the exit rules, the money management rules, the risk management rules, all written in your skills acquisition plan or your trading plan. And so all of our customers get a trading plan and they follow that by the rules. Exactly. The system, the edge takes care of cutting losses and letting profits run. It takes care of not giving entry signals when the market's falling. It does all that for you, like the croupier does with the roulette wheel. They don't change anything. They just execute their system of spinning the wheel. So every time you take a trade, you're spinning the wheel according to your edge. You are in the flow. Your edge is your flow. It's your flow. It's the way you communicate with the market. So the market communicates with you in price action, and that price action determines probabilistic, independent, random probabilistic outcomes. So the market talks to you. It's the language of the market is price action. You listen in price action. Your edge, your flow interprets the price action. You follow your edge and your flow to get the profits from the market. And the market continues to provide you with this endless flow of opportunities that your flow, your edge communicates, listens to the market with to generate profits. But those profits don't happen in a straight line from 0 to a 45-degree angle. They happen with bumps in the road and ups and downs and challenges and like a path you might be trying to take to a mountain peak, right? And all of that. And you have to be fit enough to be able to handle all those, mentally fit enough to be able to handle all those. But you continue listening, and the market says to you, right, you understand my language. You understand the probabilistic complex system environment that I am. I'm going to reward you with profits. And you do that by executing this probabilistic edge in my environment, and I will continue to reward you. That's effectively what's happening. You trade both Australia and US. Is there an advantage to trading multiple markets versus just a single market? Absolutely. There are, despite the old sayings of America gets a coughs and Australia gets a cold, et cetera, all the international markets are very seldom totally in sync. And they go up and down by varying degrees. So my view on trading the US market as well as the Australian market is there are different opportunities. They're big opportunities, but the biggest reason is that I think from a risk management perspective, as an overall, what we teach and what I follow is a core satellite asset allocation framework. So part of that is also hedging against currency risk. So the old Aussie battler has battled for some time, but at some stage, what you want to do is defend your home, not defend, is you want to hedge your home currency, and you do that by going into another currency. So effectively, I'm across 3 currencies, in inverted commas, Australian, US, and Bitcoin, and a couple of other, which won't go into that now, but it's, so in the first instance, you're hedging your home currency, and then you want to, when that money is in another currency, you want to invest it. So you invest it in the stock market, and you are getting an overall return with being in two different markets. So it's and trading the US market on most trading platforms in Australia is actually easier to trade the US market than it is to trade the Australian market, because there's this wonderful thing called a market on close order, which is starting to roll out in Australia now, because they just changed the auctioning system at 4 o'clock. But you put a market on close order on, I can put it on now, and it'll trade at market close on Monday's US session. And it's literally takes, I get the signal from my mechanical system, would it come through at 10 o'clock this morning, and I put on, if there is a signal, I can put it on then anytime on the week, anytime before the market opens, and it'll close. Whereas with just about every execution platform in Australia, bar one, Saxo, we do have market on close orders for the Australian market, you've had to execute your trade during market hours, either at a limit, some kind of limit, or some kind of market order. But I think now that's changing. There are some market and close orders just coming in the last few weeks on the Australian market. So I definitely see there's an advantage to both. Australia has half of the returns on the index, on the accumulation index in Australia is dividends. In America, it's about 20% is dividends. Yeah. Okay, Graham's asking, do I reject strategies that have drawdowns greater than 10%? Absolutely not. Absolutely not. If somebody put a system to me that had a drawdown of less than 10%, I'd say it's curve fitted, 100%. Definitely curve fitted, over optimized. I would reject it if it has a drawdown, historical drawdown of less than 10%, not the other way around. Absolutely. If you can't handle a 10% drawdown in the markets, then you're not cut out to trade. End of story. Let me put this to you. Money in the bank has, on average, over the long term, 4% drawdown. There you go. Money in the bank. If you took money, put it in the bank, no interest, you are getting 4% drawdown. That's just in a normal cash savings account that gets no interest. Consider that. So consider how many hundreds of millions of dollars there are in Australia that are sitting in a cash account that gets no interest. Think about it. They are automatically getting inflation drawdown. And inflation, over the long term, inflation has been greater than 4%. If you take it over the last 60 or 70 years, it's probably been closer to 6.5% over the long term, averaged. So you're already getting that by doing nothing. And you're kidding me? You're saying that you can't handle 10% drawdown in the market? Sorry, Graham, trading ain't for you. You're going to have to find something else. So it's, I would reject any trading strategy put to me that has drawdowns of less than 10%. I'd only look at them if they have drawdowns of greater than 10%. I'd be highly suspicious. In fact, I'd guarantee you that it's curve fitted, 100%. Yeah, I can see some of the stuff I've said today would challenge people, because I know for a fact, having been in this game for been trading for 35 years, it took me probably about 10 or 15 to work out what the biggest problem is that people have, and it's handling drawdowns. Undoubtedly, handling drawdowns. People just struggle with it, and they don't struggle. So what do? They try and solve it through analysis. Ain't going to happen. Just like Graham is doing there. So he's trying to solve his mental trading skills problems with analysis. Ain't going to happen. Thanks for that question, Graham. Hopefully I haven't chased you away from trading forever. Right, any other questions? Sure, glass of water. No more questions?
Well, Gary, it does seem like the questions seem to be drying up, so I think you've done a wonderful job there so far. Any further last questions for Gary before we wrap up? Okay, well, I guess it just leaves me to say thank you very much for a wonderful, fantastic session, Gary. It really was insightful, and I share your view that this is really where the money's made, not in lines on charts or what to buy and when to buy. It's really how you manage your emotions and how you execute consistently. So, I think that is a really good takeaway for everyone here today. Thanks to everyone for tuning in and taking the time out of your weekend. It's been another fantastic session. We will be having more of these in the future. But right now, it's just once again my duty to say thank you very much, Gary, for your time and your expertise this morning.
Pleasure, Alan. Enjoyed it thoroughly. Enjoyed the preparation for it as much as I did giving it.